Hi, welcome to Elevate Market Chat. This episode was recorded August 22nd, 2024. In this week's episode, Shane and I discussed the upcoming Fed meeting, the Jackson Hole Fed meeting that is also occurring this Friday, the presidential election cycle and whether that really matters for investors, managing through volatility when it comes to managing a portfolio, and lastly, we'll hit on NVDA, which also reports earnings next week. Thanks for tuning in. Shane, how's it going?
Hey man, it's going well. How are you today?
Doing well. Curious to see what the market's going to hold. I was telling you earlier, this is the third recording of this where the S&P has been essentially flat. You know, we've seen some ups and downs in the middle, but now maybe the Fed will give us some fireworks, and maybe next time we'll meet when the S&P is at a different value. But always watch the markets, so we'll see.
Yeah, that's kind of wild that that's happened. So like around the 22nd or 23rd of the month, I guess, was July, and it was right around this level. And a month prior to that, I guess, it was a little lower. But yeah, I mean, not, if you only listen to this conversation, you'd think that the market's been flat for the last 3 months, and boy, would you be wrong.
Mm-hmm. So little bit of volatility, which it's nice to get. We can be a little more active at times, and that presents some opportunity. And we can talk a little about that later on here, just kind of how we thought about it going through this pullback. And it wasn't a huge one. It's less than 10%, which doesn't really meet the definition of a market correction. But the big one, I think, is just the Fed tomorrow is going to be talking about some stuff. You've been shooting headlines across in Slack. But the big one is September, that meeting coming up. So I'm just curious, how are you looking at it? What are your thoughts? And the meeting is September 18th. So
Yeah, so these knuckleheads are all meeting this week in Jackson Hole for their the symposium. I can't remember like what the actual name of it is, but every year all of the bobble Fed heads get together in Jackson Hole, Wyoming, where the rich people's playground, to go and talk about money and inflation and interest rates, and I don't know, I guess look at some buffaloes and whatever else they do. I'd love to see one of these guys trying to like get a picture with a buffalo or something like that and just get kind of creamed by it. Because man, I just wish the Fed would leave monetary policy alone. They don't seem to do a very good job. I mean, these are the same people who told us inflation was transitory for years. And people still, we have to talk about it though, because a lot of people in the marketplace and just in the general economy pay attention and react to what these guys say. So whether I think they're right or wrong or doing a good job or a bad job kind of doesn't matter. We still have to pay attention because the market will react to what's going on. So Chair Powell will give a speech tomorrow at the conclusion of the meeting. A couple of years ago, his Jackson Hole speech is what sent the market tumbling. I can't remember which year it was now because they all kind of blend together. But one of them was like a very obvious point you can go find on the chart in, late August of, I don't know, I think it must have been 2022.
I think it was, and I'm looking at it here. Reuters had an article on it, but down 3.4% after he spoke.
Yeah, really. So somebody else is talking about that too, I guess. Yeah, that was actually, that sent the market from, a nice little bounce it was doing during that time down about 20% to the lows in October of 2022. So, and then, the last year, the market peaked on July 31st. So, market fell about 11% from July 31st until October 23rd. And so during that time frame, we had the Jackson Hole speech, and it didn't save the market from declining or anything. So anyway, I don't know. I think the market is expecting this rate cut in the September meeting on September 18th. They expect the Fed to cut rates by at least 25 basis points. They were trying to price in an expectation of a 50 basis point cut, but I don't think that's going to fly. Personally, who knows? A lot could change between now and then. But the market is expecting a dovish Mr. Powell. But as of this morning, there's been some headlines out that maybe we won't get the dovish Mr. Powell tomorrow talking about rate cuts the whole time. And so as we're talking today, the market's selling off pretty good. After a bounce, off of the lows, like you said, market fell 10%, over the course of the past few weeks, and then bounced real aggressively. I don't know what the date. What was the? I got the weekly chart. So from August, I think August 5th was the low.
Yep.
And so markets rallied 10% from there. Almost got back to a new all-time high. And this morning, the S&P 500 is fallen back almost 1%. Because I just think the market's finally realizing they might not get as dovish or more likely to cut rates Powell's speech tomorrow as they were originally hoping for, and so people are just positioning for that after a nice bounce off the lows. So don't read too much into one day, but technically, if you were drawing a double top pattern on a chart, that this would be a pretty good example of one. So if the market can't break out to a new high, we're going to see that double top kick in, and I think that brings the August 5th lows back into play, which is basically 10% down from here. So
Yeah.
I would just expect more volatility in the short term, man. I think wouldn't be surprised if we see more volatility. The first 8 months of 2024 have been like one of the least volatile periods on record. The stock market didn't have more than a 2% pullback for a day. And I can't even remember. It was like 300 some trading days. I don't know, going back to October. And that's the longest in history, I think, if I remember right. And so I don't know. I would just expect a little bit more volatility over the next few weeks and months than we've seen over the past, say, 8 or 12 months.
And I would agree. I think that we've been in this period of low volatility, and the market does move in cycles. So it's expected. And I think that the Fed cutting rates, they like to not surprise the markets. So everybody expects 25 basis points. So like you're saying, pretty well priced in at this point. I don't expect an announcement and the market's going to make this huge move. But we also have a presidential cycle. And, two parts there is, what do you think short term? Is that something to be thinking of? And then just historically, presidential cycles, have you kind of looked at what those outcomes look like? If we get a Democrat in office, is the market going down a lot or is it going up a lot? I know that question comes up a lot.
Nope. Well, look, before we go on to the presidential cycle, which we should talk about real quick, I just want to go back to you've heard the saying, I'm sure, Kyle, buy the rumor, sell the news, right? It's a pretty age-old Wall Street idiom, and just what that means is like, you buy the rumors. So if it's rumored that the Fed's going to cut rates and everybody's speculating that the Fed's going to cut rates, say, for example, on September 18th, you've got it down to the day when rates are going to go down. And of course, in the economy, a lower interest rate means higher inflation probably, and higher growth and higher prices, all that kind of stuff. So if you know that, if you know in advance, right, you've got the newspaper from September the 18th, and you know that the Fed's going to cut rates by 25 basis points. Look, everybody in the world knows that. And here's what's going to happen is everybody in the world is going to position themselves ahead of that happening, right? So because they know it's going to happen. So that's the rumor, right? So we know this is going to happen, or it's at least rumored to be happening on September 18th. And so everybody in the world is going to position for that. Now, what happens on September 18th? When everybody who knew that that was coming, or at least thought it was highly likely, right? They've all put all the money that they want to buy stocks with. They've done that. They put it all in because they were anticipating this movement by the Fed. So on the 18th, when the Fed finally does cut rates, because everybody's again expecting that, well, the market's going to rally once the Fed cuts rates, right? But by the time we get to September 18th, everybody who wants to buy all their stocks has already bought all their stocks. What happens when the market opens the next day, right? and the only people that show up to the market are people who want to sell
Hmm.
because everybody wants to buy is already bought. And so here's the deal. That's buy the rumor and then sell the news. So when the news finally hits, they're selling. And so I see that kind of happening. If you look back through history, usually when the Fed starts cutting rates, it's an acknowledgement that the economy is in poor shape, um, and unemployment is not in a good place. And usually that leads the stock market lower, right? It's not until they stop cutting rates that the market finally finds a bottom and begins to rally again. So, you know, I don't know for sure that it will play out exactly the same way this time as it has historically, but that's what it looks like, right? And there's good reason for it. Human behavior hasn't changed since the beginning of time, right? So there's no reason that it should be different this time. Each time is unique, sure, but history often rhymes. So that's kind of what I expect to play out as it relates to the rate cut situation for September 18th. And so, I'm happy to be wrong about that, but if I had to, I'm prepared for that outcome, put it that way. I'm not going to predict for sure that that's what will happen, but I'm absolutely prepared for that to be how it plays out. And we'll take the appropriate action if that is what happens. So,
Yeah,
um,
and I think if we take a step back from being the economist and just look at the risk management piece here, the S&P's up 17 or 18% year to date. How is it going to get accelerated up beyond that because of this event, right? You're now in a situation where investors have made a very nice, profit for the year if they were in the S&P 500. Trying to capture that extra few percent on this news event probably doesn't play out that way. Odds are that it kind of reverts to the mean, which means, sideways or maybe a little pullback.
yep. Yeah,
So,
and I mean, with that, before we move on, we need to move on, but I will add, and I haven't written about this yet because the news just broke, but I'll probably write about it in my upcoming commentary. Is that the Bureau of Labor Statistics that puts out the jobs numbers every single month. Um, and again, this is just more government data that we pay attention to, not because we think it's perfectly accurate, but because the market pays attention to it and reacts to it. But so every month we get this data on how many jobs were created and how many people applied for unemployment. Well, over the past 12 months, uh, and forget about the which 12 months we're talking about, but this, they do this every year. They do this revision, and what they said was, well, we overestimated the job creation by 867,000 jobs or something like that. That may not be the exact number. Call it 800,000, but yeah, they overestimated the job creation by 800,000 plus over a 12-month period. Like, how do you miscount by 800,000? Like, that's that's a lot of jobs to just act like we've been adding. Like, oh, never mind, those weren't real. Those
mhm.
jobs don't actually exist. Those people, right? Every one of those numbers is a person who actually doesn't have a job, but the government thought they did. So a lot of things that I'm looking at are indicative of like just people living in a fairy tale. Like, I don't know. I mean, the wealthiest people in this country have no problem with prices increasing and interest rates being higher and home prices going up because they own all the assets. So they're getting more and more wealthy as that happens. But the bottom half of the people are getting less wealthy and are least able to afford these price increases. And on top of that, they're losing their jobs. So I don't know. I don't think it's a real good situation. Who knows how long the market can kind of just rally, in its fairy tale world. But at some point, it always recognizes reality and then deals with it accordingly. So anyway, we should
Yep.
probably move on to the presidential election.
Yep. And I think I heard you say no, it does not affect the market. Is that right?
Yeah, absolutely not. If you look at every term of every president, Democrat or Republican, going back to the beginning of the markets, the market has been up for every single 4-year period of every single presidential term, with one glaring exception. And I'm sorry, all the Republicans in the world. That one exception was under George W. Bush during the Great Financial Crisis. There was only
Hmm.
That's the only 4-year period where the market was down, and I would submit that you know love him or hate him, think he's a moron, who cares? It had nothing to do with the fact that he was in office, because he inherited a problem that existed long before he took office. And, when he finally exits, it's just a simple timing thing. So that
Yep.
could have easily happened, just as easily happened on a Democrat's watch as a Republican's watch. But it just doesn't matter. There are some presidential cycles that seem to have some trading edge to them, but it's like a weird timing. It's like from October to October of the third year of a presidential cycle is what you want to be long. Like that's just the best performing period for whatever reason. So I take it or leave it. That's the way it works out. But it does not matter if a Democrat gets elected. You shouldn't your stocks. Uh, people people want to sit on the sidelines and wait and see who wins the election to decide what to do with their money. There's really no good reason to do that. I understand why people want to do it. It makes them feel good, and sleep at night is something that is invaluable, right? So if that helps you sleep at night and you can afford to do that, then so be it. But there's absolutely no reason, to sit on the sidelines and wait it out and see what the president's going to do. And then, if a Democrat's elected, just put all your money into 4-year U.S. Treasuries. Like that. That's
Yep.
actually a really bad investment strategy. I would not recommend it. But a lot of people are going to do things like that, and that's our opportunity.
Yep. And it's one of those things, typically the preceding president's policies don't truly kick in until the next term. So it's just not really something to be thinking about when investing long term. So I think the big one too is, and more importantly, Shane, is just market cycles. So markets will trend for a while, they will consolidate for a while, and consolidate means just kind of move sideways. And I was curious, maybe to get into the mind of how you look at the market and maybe what thoughts you had going on. We did have almost a 10% pullback here. How are you thinking about that? What actions were you considering, or a playbook, if you will?
Yeah, well, in my most recent commentary that is posted on our website in the news area, I did write about this a bit the last time in August. I think it was August 12th that came out. But it was only a couple of sentences. I mean, the question is like, hey, is this first 10% the beginning of something bigger? Or is it just a normal, healthy correction within, a longer term bull market? Because usually a bull market is going to last several years, and it's going to experience several 10 corrections. And every single one is a buying opportunity until it's not. And so I don't think that has even been decided just yet. I mean, we broke out, we dropped by roughly 10%, just shy of 10%, and then bounced back above kind of the trend line of I guess lower highs, right? So we did break above that, but we haven't put in a new all-time high. And as of this morning, we're basically creating what's called as a double top for traders, right? So we rallied right back to that all-time high, but didn't quite break through it. And so until we get through to a new all-time high, I'm still of the mindset that first nearly 10% drop could still be the beginning of the next bear market. It could be. I'm not saying it is. We certainly haven't sold all of our positions and sitting in cash because we think we're in a bear market already. So don't misunderstand me. But I just think that forward, we could easily percent right where we were on August 5th, and then take a trip down to the 200-day moving average on the S&P 500, which for right now is, let's say, from where we opened this morning, the 200-day moving average is 9.85% lower, just barely below the lows on August 5th. So, if we can't put in a brand new high by the end of the day today or tomorrow after Powell speaks, then I kind of look at it and say, I think there's more downside ahead. I mean, I think we could bounce between that 200-day moving average and the recent all-time high, like where we were this morning. We could bounce in that range, just trade around in that range for the next several months. We could just go sideways right till the end of the year, while people position for elections and all those other kinds of things. So that would be, nobody ever talks about that on CNBC either. The market's going to the moon or the market's going straight down, right? It's all just the extremes, right? Same thing on the political side. It's nothing but extremes. All the nuance is gone. So what happens if the market just bounces around in a 10% range sideways for the next year or 2 or 3? I mean, that easily happen. And that's a possibility too. But that's all more trading type stuff. I mean, you know, I think it's important to separate trading and investing, right? So that's a trader's perspective, all this double tops on 200-day moving averages and all that kind of thing. As far as what we were doing and what we were thinking for our long-term investment portfolios, the Elevate Capital strategy and the Elevate Capital low volatility strategy, we didn't do much. We didn't stop out of anything. That may not be true. We may have stopped out of one position during that pullback. I can't remember which stock it might have been offhand, but I know that we added a brand new stock to the Elevate Capital strategy as well on the pullback. That stock is up. Well, we just looked at it. It was up. It's up 35.74% in the past 16 days. We bought it on 8/6, right? the day after the market put in its bottom, and then we added to it, I think, a day later. And so, I mean, we looked for we had some cash heading into that pullback because things were getting a little frothy, as they say. So, we had dialed back some of our exposure. We were holding some cash, and so when the market dropped 10%, we got a couple opportunities to buy some names that we've been watching for a while, and so we took advantage, and that has so far worked out. So we'll keep doing things like that. And now that we're right back at this all-time high area and double topping, for people who are sort of in need of a rebalance, or are changing strategies from kind of one to the other, or getting a little bit more conservative or getting a little bit more aggressive, today's a great day to be going and trimming positions and a little bit of kind of doing that side of the. We're not going to sell positions and do a lot of buying here at these all-time highs. If we break out, then maybe I will. But in the meantime, we're mostly raising some cash for people over the past couple of days who need to raise cash for various reasons, and we'll see what happens from here. Either we break out or we go back and revisit the lows. I don't know, but I'm prepared for either.
Yeah. And Shane, you brought up an interesting point. So with this individual stock that was picked up, there are a lot of people that did passive indexing for 2009 to present, and it's been wonderful. But now here we have a pullback, and if you had just the S&P 500, you could have bought that dip, made about 9%. But here you're highlighting an individual name could have this, outstanding return. When you think about the market ahead, what do you think might be the winner in a sideways market, or more just not a strong trending market? Is it just buy the SPY for the next 10 years, or is it finding these opportunistic names that have not caught up to that rally as much? And does that then give a benefit to maybe being a little more active and having a diversified holding of the best stocks in an index?
Yeah, well, I think I'm biased, obviously. So you kind of set that one on the tee for me, because you know that I'm an active manager. I like bottom up investing. I like to find companies that are going to do well in any macroeconomic event relative to their peak, right? Survive. They're going to one stock I was looking at last night. I haven't done anything with it, so I don't feel bad talking about it. But Wynn, the casino, WYNN is the symbol. The thing's cheap, man. It's cheap, and of course, going into let's say we're going into a recession and a bear market and all that. Well, people aren't going to be out gambling. Mass market people aren't going to be out gambling. But I said earlier that it's a K-shaped recovery, right? So you got the K and you got you know, the one arm that goes up and the leg that goes down, right, away from the vertical line in a K. So the wealthiest people are doing just fine, and the bottom of the income ladder are not doing as well. And the wind focuses pretty much exclusively on the high end of that K, right? And so I'm looking at gambling's a great business, right? People always say, "Oh, you want to be the house, not the gambler." Well, that's true. They literally just print money. Um, so it's a great brand. It's focused on a luxury clientele. They're going to do relatively better in a recession than lower income people. And so to me, I'm looking at Wynn Resorts and I'm like, man, maybe this is a good time to take a stab. And so I just started reading all of their conference calls going back a year and reading everything that's been published by the company as far as they're building a new casino in the United Arab Emirates. So that'll that one has cost with no revenue right now, but if revenue going to grow because of that. And so there's a lot of moving parts, but I like bottom up investing and looking for a company that's going to do well relative to its peers, no matter what the macro environment is. And hopefully you can hold this stuff forever through recessions and bull markets and recoveries and all that kind of stuff. So for me, what I like to do is buy companies that I can hold forever. I can give the shares to my kids or my grandkids someday. Is the whole trick to that is buying them at the right price and not selling them, right? Just don't get scared. And so you got to, number one, buy at the right price. Like that is the key, is don't overpay for stuff, because there's a great stock out there called, say, NVIDIA. If you pay 76 times earnings and 40 times sales for it, you're probably not going to make any money over the next 10 years. Maybe the rest of your career. If you hold that for the rest of your life, you never make money on it. Now, by the same token, if you were to be able to buy that company at, say, 10 times sales, well, that's a whole different matter. It's a great company. I wouldn't pay 10 times sales for very many companies in the world, but NVIDIA is one that I would. I think that's the fair price because they are growing rapidly. But 40 times sales is ridiculous. Like the expectations implied by paying 40 times sales for something are basically that NVIDIA will make up, say 20 or 30% of global GDP in like the next 10 years, which is just ludicrous. It's not even possible. So I don't know. The expectations implied by that are just, I can't get on board there. Now, can you trade NVIDIA? Sure, you can trade it here. It might go up more. But buying it as a forever type holding at this level makes absolutely no sense. So for me, I think we've demonstrated over a long period of time that if we buy stocks by good companies at fair prices and just hold on to them forever, things tend to work out really, really well, and we don't have to worry too much about the macroeconomic situation.
Mm-hmm. Yeah, and it's interesting you mentioned NVIDIA because I am sitting here and today would actually mark the third lower high. So that's an interesting observation. And then they do have earnings on the 28th next week. So I'm curious to see what happens there. But I think you just nailed it. Buying and holding it now, not very good. Is a trade fine? But if you're buying something that is this overvalued and thinking it's going to appreciate that much more over the next 10 or 20 years, that's a tough place to be. And I think we're seeing that just in the stock market in general, is a lot of multiples are stretched, and thinking that right now is a great time to get in without risk management, that might not end as well.
Yeah, and don't get me wrong. I mean, Nvidia is a great, like, again, you can trade it. I've been long this stock and short this stock in the past couple of months. I mean, it dropped by 35% or something recently. That was its third correction of 2024. So if you bought Nvidia, right, you could have bought Nvidia at $90 on August 5th, and today it's $124. So you could have made 37% in the stock, trading it in 15 trading days. And so you can trade this stuff. I've said it a couple times today, like there's a difference between trading and investing, and you need to know what you're doing, right? We do both, right? We'll make swing trades in our Elevate Capital strategy. If we just have cash and we want to use it to take a couple of shots and speculate on some swing trades, we'll absolutely do that in that strategy. We don't do that in our low volatility strategy, but we will do it in our flagship. But we never do it with more than like 10 to 15% of the overall portfolio, and it's usually a lot less than that. We've got a couple swing trades on right now, and they're working well. And I personally, I traded NVIDIA both long and short. I sent you a screenshot, to the team actually. Kyle, you were in there, 2 days ago, and I said, looks like maybe NVIDIA could pull all the way back to its recent lows, which is down about 25% again from here. And so I'm currently, as we speak, I'm short NVIDIA from, see if I can tell you what my entry price was. Weird, my computer is not doing what I want it to do right now. But anyway, I shorted it around $128. And today it's at $124. So, I'm up a little bit, up about 4%, shorten this thing from here. And so I trading around a position is a good idea, but don't confuse your speculations with your investments. That's a recipe for disaster. But I don't think you have to pick one or the other. You just have to know what you're doing, right? So
yep.
Write it down when you buy something. Why'd you buy it? And what are your exit rules, right? You should never buy anything without knowing how you're going to get out of it. What was your thesis? If your thesis is wrong, you better get out. Or if it drops by enough, you better get out. And that's true for investments. I said earlier, and I know we got to wrap up, but I said earlier, like, hey, we want to buy great companies and hold them forever. But just because I want to hold them forever doesn't mean I'm going to hold them forever. Facebook, Meta, great example. It's a forever stock. If you pay the right price for it, you can hold it forever. It was down 80% in 2022. I would not have been holding through that, right? I mean, I would have maybe dropped by the first 25 or even 30%, but I would have been out after that, and then looking for a new entry, to buy it at a great price and hold it forever. So even with forever stocks, even when I say, oh yeah, it's a forever stock, we want to hold it forever, doesn't mean we will hold it forever. Even the greatest stocks have massive pullbacks where you would not want to be involved.
Right. So the big thing here is just risk management and knowing what you're doing. That's the important one. Is, are you investing, or are you going to be a little more active? And if so, what's the plan? And that's what we always aim to set out with. Is, as we talk about economics, and that's great, but we are not sitting here with a crystal ball. We don't know what the outcomes will be on really anything. It's just manage risk and you'll be rewarded.
We eliminate the losers as fast as possible, so that way all we're left with is the winners. That's it. It's really that simple, and all it takes is discipline. But most people do not have the patience and the discipline needed, which is why I don't see us ever being replaced by AI.
Yep.
I think it's a rare set of characteristics that just if every human was good at patience and discipline, there would be a lot different about this world.
I couldn't agree with you more. So awesome, Shane. Well, thanks again for taking the time. I think we'll wrap it up here, but our next market chat is September 26th. So look forward to having everyone tune in again. So be sure to like, subscribe, share this with your friends, and we look forward to chatting again next month.
All right. Thanks, Kyle. Have a good one, man.
You too. Bye. Special thanks to our audio engineer, Stephen Crowley, for mixing this episode. This podcast expresses the views of Shane and I as the date indicated and are subject to change without notice. Elevate Capital Advisors has no duty or obligation to update information included. All information is for educational purposes only. Certain information concerning economic trends and performance is based on information from sources deemed to be reliable and has not been independently verified for accuracy. Wherever there exists potential for profit, there's also the risk of loss. This podcast may not be copied, reproduced, posted in whole or in part in any form without prior written consent from Elevate.